After a number of years, the folks at Social Security have redesigned your Social Security statement. So we're going to talk about some of the changes that happen in this redesign, pros and cons, if you will, of it. But at the end of the day, it appears to be presenting the information in a little bit better format. So some good news there for anybody curious about their Social Security, and why wouldn't you be in that front. Also, we're going to be sharing with you some of the questions that you should be asking yourself as you're approaching 60. And the reality is, of course, on those questions, you could probably be asking them at any age, but certainly if you're not asking them as you're approaching 60, you really may want to. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. So all of our fans on the sports network. And then, of course, our newest addition to the lineup, the folks over on the Space Coast at 92.7 WMMB. So excited to have the whole swath of Central Florida listening to us on those variety of channels. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. Speaking of that team, next week we're going to have one of the members of the team, Kristen Cayley, our in-house CPA, join us here on the program. So we're excited about that. We're going to be talking next week about the letter that a lot of Americans got that has to deal with the child tax credit and whether you want to get that along the way. So make sure you dial in next week. It's 4th of July, so we'll be sending fireworks all over the place when we talk about the latest out of the IRS with one of the members of our team, Kristen Cayley. That's on next week's program. Before we get to next week, we have to kind of take stock of this week as well. Hard to believe, it is the last Sunday in June. So that means that we are at the turn, right? By the time we get back on the air next week, it'll be the 4th of July and the year will be half over. Always a good time to sort of take stock when you're at the turn, if you will, in the year. And certainly we did that this past week in a communication that we shared with all of our clients. We'll share some of that with you here in this segment of the program. It's certainly an interesting conversation that we're able to now have, one that we're particularly excited about, because as an office, we do a variety of events during the course of each and every year. We have one educational dinner session a quarter, and then we also do a special client celebratory evening. And so, as you might well imagine, we've had to cancel all of those over the course of the past 15, 18 months. So one of the things that we talked about in the communication to our clients this past week is, hey, you know what? We got to lean into this and start to embrace it. So we're bringing back our normal rotation of events starting this fall. So we're really, really excited about that. Also excited about some big happenings at the office as well. We're about ready to expand at about 1,400 square feet to the back of the building. If you know the building or you've been to the office, you know that we've been in the same location for 25, 30 years. And so it's time to kind of expand out the walls and get a little bit more space so that we don't have people doubling up in offices and all that kind of stuff. So those were the things that we talked about in the communication to our clients this past week. And of course, we recap the markets as well. If you're a regular listener to the program, you know that there is the dynamic out there that is playing out right in front of our eyes. each and every week. And that's the dynamic between demand, this huge demand that we're seeing as people re-engage and restart in a variety of activities. And all of those activities typically involve spending money. So the problem is, on the flip side, if you will, the other side of the dynamic, that is this notion of inflation, the fact that things are costing more, and what's the implication of that going to be? Is that going to require the Fed to raise rates? Well, the week before last, it was the inflation concern that was sort of dominating the picture, right? So the week before last, it was the worst week for the markets since October, and then all of a sudden the calendar flips, and so this past week it wound up being the best week in the markets since February, because the demand story prevailed. So if you just stop and think about what has gone on in the markets over the past couple of weeks, we've got this past week where the demand story, yay, demand story winning, yeah, everybody's out spending money, good for the economy. Prior week, it was the inflation, the potential for higher interest rate story that was sort of ruining the day, if you will. And last week on the program, if you recall, or if you don't recall and want to catch it on one of our podcast channels to listen to it, you can certainly do that. We talked a little bit about some perspective, if you will, looking at the past 20 odd years. Remember the conclusion of that conversation. If you go back over the course of the 3 prior bull bear cycles, which has you investing at the worst possible time, the peak of the market in March of 2000. You then go through the dot-com bubble burst. You then go through the financial crisis. You then go through the pandemic. And lo and behold, if you were so unlucky to invest at the market top in 2000, just prior to that first major decline in the markets, the first of 3 over the past 20 odd years, you'd still have an annualized return of about 7%. So that's pretty good through all of that. So remember, as you look at this perspective, that it is really more about time in versus timing. Excuse me. You know, as you wake up in the morning and there's nobody around the house because everybody's still asleep because I have teenage boys, there's nobody to talk to. So the voice doesn't work as well here in this first segment as we want to. I think I need to kind of wake up one of them and start talking. Anyway, so we digress. Now we're back. Got some water. So the demand story is certainly an interesting story that I don't think we can really say enough about. The GDP projected for this year here in the U.S. is expected to be above 6%, according to the IMF, the International Monetary Fund. The personal savings rate for the first quarter of this year, just nothing but staggering when you kind of look at the numbers. And remember, Q1, we weren't open, right? Or we were starting to open, but not to the extent that we are. So in Q1, the stimulus, or between the stimulus and the increase in jobs that you saw happen during the first 3 months of this year, increased the savings rate, the soared to 21% of disposable income. Restaurant reservations were at near pre-pandemic levels. So good luck finding a waiter, though. That's a different problem, right? Because if you've ever been to a restaurant, you see all those signs, and service is a little bit slower because they're having to do with less people. Certainly some other interesting trends as well have played out of late. When we get back from the break, we're going to share with you some of those more interesting trends, and then we're going to shift gears and talk about the redesigned Social Security statement. All that and more coming up next here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So Social Security is quietly rolling out a redesign of your Social Security statement. You know, the traditional statement that maybe you've seen it, maybe you haven't, because they used to mail it out to everybody, then they stopped and they restarted. The reality is that if you're over 60, you're going to get it in the mail unless you've set up an online account. And then once you set up the online account, just like everything in today's world, you no longer get it mailed. You now have to remember your login and get it online. The reality is, though, that they are quietly rolling out this redesign. Started in the 1st of May, and sort of like a soft launch, if you will, almost like a restaurant, right? The biggest change is that it is no longer 4 pages. It's actually only 2 pages. So that's a pretty big change when you reduce down the information that you were getting by 50%. There's also a lot more changes on it as well. So in this segment of the program, we're going to spend some time going over what those changes are so you can perhaps become more familiar with it, so that when you look at your Social Security statement, it won't be a surprise to you, because it's going to look quite different. Well, it's half the size that it used to be than what you used to get. So welcome back to the program, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel of choice. Just make sure you search Dollars and Cents with Joel Garris or simply Nelson Financial Planning. Either one of them gets you to where our podcast channel is on your preferred media network. You can also go to our website, nelsonfinancialplanning.com. Upper right-hand corner, there's a bunch of icons. Click on the one that looks most familiar to you, and you'll get directly connected. Anyway, my name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So besides less pages, and when you go from 4 pages down to 2, that's quite a bit of a change in terms of the length. The folks at Social Security redesigned a variety of other aspects of that traditional Social Security statement. And we've got a sample. We're going to hold that up for our YouTube audience, and we'll post this on the various social media channels during the course of this week so that you can also see what it looks like. The biggest change is that the prior statement, it had a number in the upper right-hand corner. And what folks had to understand, that number in the upper right-hand corner was the amount that you were going to get at your full retirement age. Well, the full retirement age has been transitioning up to age 67. So many people, between the confusion over, well, when exactly is my full retirement age, and kind of looking quickly at a number on the page, didn't really appreciate exactly what that number meant and in exactly what age you could get that number. For that, with the old statement, you had to turn the page and go to page 2 and then kind of read through sort of some of the different information and some of the language and the numbers that were associated with that. So what they did on this one is they wound up creating a little bar chart. And the bar chart, rather than just having 3 ages that were 62, 67, and 70, which is what was on the old statement, assuming your full retirement age was 67, they now break it down based upon specific ages, every age, if you will, from age 62 to age 70, so 62, 63, 64, every individual age. And on that bar chart, it has the amount of Social Security that you're going to get at those particular ages. So that's good, because that gives you a lot more specific information. So despite the fact that they cut it down in half, the reality is that they're presenting the information in such a way that it gives you a little bit more specificity and a little bit better information relating to the age at which you take Social Security. What's interesting about this, and obviously when you do this, and I'm sure there's a lot of folks that were involved in the design and the presentation of the material, the reality is that you've got a definite sort of suggestion, or I guess I don't want to say conclusion, but you can kind of conclude it. The message, or the subliminal message on all of this, as you look at this bar chart, is that if you wait, you will get more, and I guess that makes sense. The interesting part, and this may be my just baseline paranoidness of government stuff. The suggestion, though, when you look at this, is to wait so you can get more money. Well, that's exactly what they would want you to do, right? I mean, because the program is not exactly in great financial shape. So the longer you wait, then they can put it off, and then, you know, in theory, pay you less, because if you wait longer to take Social Security and you have the same life expectancy, that means that they, you know, aren't going to have to pay you out as many years. So, but anyway, I digress. That may or may not be the subliminal message. I'm sure there's, you know, something to that, but it certainly does present the information in a much better way that allows you to see exactly what you're going to get if, say, you decide to retire at 64 and start to collect Social Security, or if you decide to retire at 65 and start to collect Social Security, versus previously where you kind of had to do some math and sort of figure it out. That was a little bit tricky. So this clearly is an improvement. Another interesting part of the redesign is the quantification of how much taxes, and that's, again, if we go to our YouTube audience, that's below the bar graph. So below the bar graph, it talks about the total amount of taxes paid under Social Security and also Medicare. And in this particular example that we were able to find out there, actually one of our associates, Rob Field, found it for us. It says that Social Security taxes paid $236,941. This particular example had a relatively high income earner. Employer paid $44,727. So the total amount of the taxes paid was $281,668. So what's interesting is it kind of gives you that. Now, remember, it still gives you you know, your earnings summary on page 2. That's what's on page 2. The traditional listing that they had of every year and your income, and one of the things that you're supposed to do, which kind of everybody forgets to do, but you really should, is that you look at the amount of money that you made in each particular year, and it should match up with the amount of money that you actually got. But it's on you to sort of verify the accuracy of that information. So that's all is still very much on page 2, where it lists the year that you know, the work year, 1998, 99, 2000, stuff like that, and the earnings that were that you paid Social Security tax on. So all of that still very much still on there, and certainly you want to check the record. But now with the redesign, they've got the total amount of taxes that you paid. And so in this particular case, what's interesting is that this individual paid a total of $281,668 in Social Security taxes over the course of their working career. At age 67, again, based upon the statement here, they would expect to get a Social Security benefit of $3,028. Again, this particular example, sort of a higher earner. Sort of curious how these numbers might play out for, you know, kind of a more normal wage earner, but this was the example that we were able to kind of find. So if you run the math, at age 67, if you're going to get $3,028, you paid in $281,000, the recoup is less than 8 years. So within an 8-year period of time after age 67, you would get back all of the money that you put into Social Security. Now, that's the kind of analysis that you hear people talk about and say, oh, you're going to get back out of, you know, a tremendous amount versus what you put back in. Partially true if you just kind of look at these numbers, but what's the key piece of information that we're not really seeing in this analysis? Well, the key piece of information, go to the earnings statement. Right? Earnings statement is a history going back, in this particular individual's case, 30 years. So it's money that you paid in over 30 years. Let's not forget that when you pay money in 30 years ago, that's worth a heck of a lot more than what it is today. So be careful about kind of drawing these conclusions on, oh, I paid this much in Social Security. That's kind of what they want you to do on this redesign. Oh, you paid this much. We're going to give it all back to you in less than 8 years. Except you gave it to them over a 30-year period of time. The reality is that's worth a whole lot more than what you're ever going to get back. But hey, they redesigned it to make the suggestion. But hey, That's just me. I might be a little bit jaded in terms of my perspective on the government. We'll take a break and return after these messages here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So the prior segment, we were talking about the newly redesigned Social Security statement. Let me start this segment by telling you how you can get your Social Security statement. Used to be that they mailed them out. They don't do that anymore. Cost saving, believe me, I get it. But the problem is now you've got to go online and create an account at ssa.gov. Make sure you're going to the right website, because there's a bunch of other websites out there that pretend like they are here to help with Social Security. And the reality is that for the most part, sadly, in today's world, they may very well be fake websites set up to gather your personal information. So make sure you're going to the right one, SSA, Social Security Administration, ssa.gov. That's where you need to go. Create an account. You'll be able to download your Social Security statement, maybe see this newly redesigned statement that they are rolling out. If you're over age 60, you may still be able to get it in the mail. If you have not set up an online account, they will still mail it to you. Once you set up an online account, they are going to rely on you to remember your login and that way get your Social Security statement. So just be aware that's how you can get your Social Security statement. So that's an important sort of thing to note as well. Welcome back to the program, of course. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. We look forward to one of the members of the team, Kristen Cayley, who is our in-house CPA, joining us on the program next week, 4th of July. A lot of fireworks. Well, we're going to try and give some fireworks of our own with the letter that the IRS sent out to 36 million households over the course of the past 2 or 3 weeks. Maybe you've got a question on it. It involves the child tax credit. We're going to have Kristen on the program next week to really dig in to what that letter means and what your options are and whether you should be doing anything differently. So be sure and stay tuned for that. Top of the program, we were talking about some of the interesting trends that were happening out there. Certainly the demand story is one of them. Seeing restaurant reservations as measured by OpenTable back up to almost like a pre-pandemic level. Some dramatic things that are happening out there. Other things that also happen sort of in the pandemic world, and we're just beginning to sort of start to see some of the fundamental impact that the pandemic had. One of the areas, of course, is on digital payments, right? Digital payments, because you weren't able to kind of go into places, everything became much more on a digital basis. 9% of all payments were made digitally prior to the pandemic. That increased to 15% of all U.S. payments. Don't expect that trend to slow down. Remember, though, just because you're paying digitally doesn't mean the dollar is going away. You're still paying in dollars. So it's not a conversation about the dollar going away. It's just a conversation about the means of exchange fundamentally changing. And certainly that's a pretty significant increase when 15% of all payments are done digitally. What does that look like? Well, let me give you this simple example. So when you use your phone, I don't know if you've used your phone to do Apple Pay or any of those kinds of or Venmo or any of that, those are all versions of a digital payment. So that's what we're talking about when we talk about digital payments. Obviously a pretty significant increase during the course of the pandemic. And another one, and this one actually I've used a couple of times over the course of the past 6 or 8 weeks, had a cold and needed to kind of get an antibiotic and couldn't really get an appointment, just didn't have the time, busy season, son was graduating high school in May, things like that. So did a telemedicine visit, and that was kind of interesting. That's basically, there's an app, you click on it, and then within a few minutes, or at least this is what happened to me when I used it, a doctor came online and was able to have a conversation. Done that twice now, one of which actually did it on the car ride, back from the office to home, and it actually worked pretty effectively. Before the pandemic, that was like non-existent. During the course of the first few months of 2020, it became 20% of all healthcare visits. Now, that number has obviously slid down from that, but it's here, it's not going away. Once people utilize it, they realize just how effective it is. Certainly worked pretty easily for me in terms of getting an antibiotic to help knock out the cold. Although I guess this morning I still had a little bit of remnants of it going on since I had to stop and get water and coffee and stuff like that, or just nobody around the house here this morning. Anyway, certainly some fascinating trends that are taking place that ultimately will drive certainly society and the market. So we'll be curious to see how all of that sort of plays out over the course of the next few years. So speaking of 60, which is sort of the age that we were talking about with the Social Security statement, excuse me, in terms of being able to generate out the statement and start to get that in the mail, assuming you haven't set up an online account. There's surely a variety of other things that you really want to ask yourself as you're approaching 60. What are some of the questions that you should be asking? I think as we go through some of these topics during the course of this segment, and we'll probably roll this into the next segment as well, that these topics are not immune to somebody that is approaching age 60. These topics are topics that I think anybody at any age should be asking themselves. But approaching 60 is a sort of a particularly important milestone because the vast majority of people sort of retire roughly around the time when they're eligible for Medicare at, say, 65, or they're eligible for their full retirement benefit under Social Security at 67. So at 60, you're kind of in that window where you're 5 to 7 years out from retirement, and your margin of error, if you will, gets much less. So that's why these are some of the big questions to be asking yourself, certainly at that age when your margin of error starts to really shrink, being 5 to 7 years out of retirement. But these questions apply to anybody at any age if they're thinking about their retirement and their future. So first and foremost, right, what's the first question? Do I have enough? Right? That's always kind of the first question. Do I have enough saved up? And it starts with kind of taking a look at where you're at now, and then sort of using a reasonable rate of return. So maybe let's just use a 7% return. That's a little lighter than what the overall markets have generated over the past 100 years. But let's just go with that kind of a number. Over a 5-year period of time, assuming a 7% return, you should have about 1.5x, x being what you have today. So if you've got 500,000 today, projecting out 5-7 years, should be around 750, give or take. Plus you also should still be contributing, maybe even ramping up those contributions, particularly since you're in the last few years of working. So that's kind of how you project out that number. And then of course you apply the traditional 4 to 6% rule. And the reason that we say that there's a little bit of a range on there is that as we've talked about in prior programs, every person's situation is unique. Everybody's numbers are unique. There's not some just general rule of thumb that everybody should follow. It really depends on what your expenses look like, what your lifestyle looks like, what your health looks like, what your marital situation. I mean, the list goes on and on and on that makes your situation unique to yourself. But if you apply the 4 to 6% rule, if you will, and what that means is that you simply do the math relative to that balance to help determine how much income you're going to get out from the invested side of the equation. As you might imagine, 4% lower, that's obviously more conservative. But let's say you're in your early 70s. Let's say you're in your early 70s, right? And you're maybe not married, with kids. That's when you can kind of think about, okay, well, could I get up more to like that 6% withdrawal rate on my assets and still be okay? And that's where the withdrawal rate and your personal situation sort of all go hand in hand to help determine that. And it certainly does all depend upon that personal situation. So here are the numbers, right? So let's say, I'm just gonna use some easy math, you've got $1 million, or you're projected to have $1 million, 4% on that would be $40,000 annually, so about $3,333 per month. If you say 6% on that, well, that's $60,000 a year or $5,000 a month. Obviously, the higher the withdrawal rate, the more risk that you could potentially get hit by market volatility and ultimately wind up having that market volatility hit the ability of your portfolio to be able to continue out the income that you're relying on. Which leads us to the next question that you need to be asking yourselves, which is it in the right mix? We'll do that right after these messages here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Talking about some of the questions that you should be asking yourself, particularly if you're getting close to age 60, right? 5 to 7 years out, the margin of error for a successful retirement gets much, much thinner. But certainly these are questions that you want to be asking yourself really at any age when you're thinking about your retirement or your future. We talked about sort of the most straightforward question to be asking yourself in that situation, and that is, do I have enough saved? We talked about that in the prior segment, and we're starting to segue into, okay, well, once I've sort of kind of need to know the number, then it becomes, the question next becomes, well, what's the right mix? And again, as we were talking about with the withdrawal rate and how much you need to save, that is truly unique for everybody. But think of the bond piece, and right, when you create a investment mix, there's the stock piece and there's the bond piece, and in theory there's the cash piece as well. We kind of like to lump the cash and bond piece kind of together as the conservative side of things. But if you think of that, and obviously the stock piece has the volatility, potential for higher return, cash bond piece is going to be much less volatility, but also much less of a return. So if you think of just sort of a traditional mix, right? Let's say it's 70-30, so you're about 2/3 in the stocks, 1/3 in the bond side of things. And let's say you're taking out 5%, like that's your withdrawal rate, taking out 5%. Well, if you do the math in theory, right, if you've got 30% on sort of the cash and bond side of things, you basically have like 6 years of income covered, right? So it's you know, you look at it historically, you go through tough market times, you know, generally those sort of come and go within a 2 or 3 year, maybe 4 year type of period of time. So if you've got 30% on the cash bond side of things, you should be able to utilize that piece of the portfolio, because after all, that's what it's there for. That's why you have a conservative piece of the portfolio to get you through those periods of time. So, you know, those are the kinds of things to be thinking about in terms of what's the right mix and why, and how that's going to work as you spin out the different scenarios that could potentially happen over the course of a 20 or 30 year retirement. So that's certainly something to think about. Of course, on the stock side, one of our chief recommendations is always to own large companies, own the companies that make the stuff that the world uses every day. The shotgun approach on this that we see all too often on the stock side of things, where you've got, oh, I've got small companies, I got mid-sized companies, I got emerging market, I got all. I think it's so much more important to more finely tune that, to own those larger companies, which ultimately helps to reduce the risk down on even the stock side of the portfolio. Because let's face it, there's all different types of companies that you could be owning, and the more aggressive, smaller, emerging market, those types of companies are going to come with a higher risk profile. So if you want to kind of sort of strike that balance, our advice is typically, hey, 90% or even more than that on the large company side of things helps to sort of balance out that risk. Now, another thing you need to be asking yourself, and this is particularly for folks that are at that age 60 or more, the reality is it's actually age 59 and a half, is as you look at what often is the biggest source or the biggest location that most people have their assets, particularly as they're approaching retirement, is going to be your employer plan, whether it's a 401k or the like. Those plans ultimately hold the vast majority of folks that are about ready to retire's wealth. The reality is, of course, sadly, that on most 401k and employer-sponsored plans, there's a lot of cookie cutter options out there. And it used to be back in the day where you could look at a traditional employer-sponsored plan and see 40 different choices of different investment options. Today, it's usually about 20, half of which are all cookie cutter target date, and the other half are just kind of plain vanilla types of options. So understand that if you're over 59 and a half, you typically will have an option that allows you to do what is known as an in-service rollover. And what that does is it allows you to, you're still working, you're still contributing going forward, but it allows you to take the money that is in that plan and roll it over to an outside IRA, whereupon you have the full breadth and depth of investment selections available to you. So that's another thing to kind of really keep in your mind, and specifically it's an option that typically is available to you once you are over the age of 59 and a half, and that is an in-service withdrawal. So those types of things might be a great way to help make sure that your investments are in the right mix, especially as you're getting close to retirement. Now, what are some of the other things besides, do I have enough? What's the mix? What's the best way to achieve that mix? Well, can't forget Social Security, right? We were talking about that earlier in the program. How much you're going to get from Social Security, that's a big part of your overall retirement picture. May want to get a copy of that newly redesigned statement that we were talking about earlier. Take a look at what your benefits are going to be at, say, 62, which is the earliest you could get, 67, which is the traditional full retirement age, and then of course 70, which is the maximum age that you can get it, and see what those numbers are. The new statements certainly breaks that out in much greater detail at each specific age between 62 and 70. So make sure as you're getting close to that age 60, where you got a few years out from retirement, that you get your hands on a copy of that Social Security statement. Similarly, another thing that folks need to be aware of is the health insurance, right? All too often, people sort of forget this along the way because they wind up having their employer sort of take care of it, and then at 65, or when they ultimately retire, they've got to take care of it. That's why 65 often is an important age when it comes to retirement, because that's when you're eligible for Medicare. But you still got to put that as part of the budget. It's not just free. Part A is free under Medicare, but Part B traditionally costs $150 and only covers 80%. So you're going to need a supplement. That's another $250. And if you want the prescription drug plan, that's another $50. So what are we up to? Pretty quickly about $450 per person, even under that. So make sure that even though you may be on Medicare, there's still a cost to that. We got a few other things that we wanted to kind of throw into the mix here. We're going to pause on those, hold those for next week, and circle back on those items as well, because the music means we got to wrap it on up and get on out of here. Thank you all for listening to the program. We look forward to you joining us next week on the program, when we're going to be talking about that letter that the IRS sent out to 36 million households over the course of the past 2 or 3 weeks. All that and more next week's program, Dollars and Cents, with your host, Joel Garris of Nelson Financial Planning.